Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I am a financial advisor, but this video is not financial advice. This video, I want to recap for you GameStop's Q3 earnings, just in case you didn't watch my 3-hour live stream yesterday and you want, or even if you did, right? And it's like, okay, after a night's sleep, digesting the numbers, let's just look at what GameStop reported, right? Let's look at the real numbers, what the company's really doing, because that is the most informative thing we can look at as far as fundamentally valuing a company. Obviously, we like to project, we like to look at forward PE, we like to look at the transformation ahead, but something we can all agree on is the numbers that have already been reported. So let me recap for you the high points of what we learned in the Q3 earnings report yesterday. Before I get into it, I just want to say thank you to those who have subscribed. A new subscriber just now. Thank you so much. I will, in a video soon, share the next sub club that we are on a march towards together. Also want to say thank you and congrats to those who have joined as fans and friends of the channel. That said, sorry, I just blanked because I'm like, oh man, I need to share my GameStop spreadsheet with Don, who joined as a friend yesterday. So thanks, Don, and I will respond to that email and share that with you today. GameStop's Q3. Okay, no frills in this video. Let's just look at the actual numbers and let's see fundamentally, are these encouraging or discouraging numbers? Because the stock would make you think that, oh wow, this must be so discouraging, right? Down 6.5%. How horrible is the company doing, right? Well, let's look. Cash and securities, $9.349 billion. So that is up $126 million quarter over quarter and almost $5 billion higher than Q3 a year ago. Their current liabilities, right, their operating liabilities are down $167 million year over year, right? So they are continuing to cut obligations, continuing to close stores, continuing to operate more efficiently. And their long-term liabilities down by more than half year over year. So their total operating liabilities are just over $1 billion as of the end of Q3, whereas they were 1.4 billion at the end of Q3 last year. They do also have convertible bonds, which are right now reported as liabilities, but 7 years from now will likely convert into a diluted float, more shares. But no new news there other than operationally liabilities down almost 40%, right? Greater than 30% year over year, their operating liabilities is a 30-something percent reduction, a $400 million reduction in operating liabilities, bullish or bearish? Well, it is bullish from an efficiency perspective, right? You could say it's bearish in the sense of, oh, they're closing stores, right? That must be bad. Well, it's bad if your goal is purely to scale as fast as possible. But if your goal is to become more profitable faster and then to scale a more efficient company later down the road, then it's very bullish. Is cash increasing by almost $5 billion year over year? Is that bullish or bearish? That is obviously very bullish and greater than a $120 million improvement in cash quarter over quarter. Is that bullish or bearish? That is very bullish. Now for their income statement. Net sales year over year, slightly down on the top line, 860 to 821, but their sales per store is actually continuing to grow incredibly quickly. So you see the breakdown of hardware, software, and collectibles. If you look at just sales per store, they made in Q3 of last year $250,000 per store, and they made $390,000 per store in Q3 of this year. So their total sales per store grew almost 60% year over year. Is that bullish or bearish? That's very bullish. Their hardware grew by almost 50% year over year in sales per store. Their software quietly has actually been growing in sales per store. So has the software business already finished bottoming out, and is it actually back on an increase? Incredible, right? Before these earnings came out, I had been modeling a 25% decline in software basically into perpetuity until it's, 10, 20% of the size that it is right now. And now it's looking like that is way too bearish. And actually, the software sales are steadying and actually growing on a per store basis. Collectibles sales per store continuing to explode. So very, very bullish collectibles year over year growth. Q3 of last year, they did $50,000 in collectible sales per store. Q3 of this year, $120,000 of collectible sales per store. How do we know the per store numbers? Basically, you know it based on their operating lease assets and operating lease liabilities. Their store count is down to somewhere around 2,093 stores compared to 3,500 stores a year ago. Can you imagine that? A 1,400 store reduction year over year, right? Another 160 stores closed in this quarter alone. And yet their top line sales is almost equivalent, right? Because sales per store is actually 60% higher. So from a revenue scale perspective, is Q2 bullish or bearish? Again, bearish in the sense of, well, they're closing stores, which limits their total upside from a top line perspective. So you could say bearish, but very bullish from a efficiency and just the value of however small the footprint gets, right? The value of that footprint on a earnings basis, on a multiple basis, is growing very quickly. They are becoming much more efficient in terms of generating sales with their stores, which also means they're becoming much more efficient in generating sales from online, which command a premium PE to in-store sales. And they're also becoming very efficient in their profitability on those sales, right? So going back up to the total numbers, gross margins at 33% at the end of Q3 of this year compared to 29.9% at the end of Q3 of last year. That is an 11% improvement in gross margins year over year. Is that bullish or bearish? That is, you guessed it, bullish. SG&A at 221.4 compared to 282 in Q3 a year ago. What is that? That is a 21% reduction year over year in SG&A. They also reduced SG&A in 2024. They reduced SG&A in 2023. They reduced SG&A in 2022. So they are on pace for their fourth year in a row of SG&A reduction, which means fourth year in a row of lower costs, which is incredibly exciting. From a margins perspective, they are on pace for their fourth year in a row of improving margins, 2022, 2023, 2024, and now 2025. Fourth year in a row of improving margins, fourth year in a row of cutting costs, cash and securities up over 100% year over year. Operating income, I'll go back up to the total number, but the improvement is a 223% improvement year over year. And that is, again, as a result, the fourth year in a row that GameStop is improving their operating income, right? 2022, 2023, 2024, and now 2025. And the improvements are actually widening in margin, right? Not only are they improving these things year over year, but they are actually improving faster year over year as well. Same with net income. So that was operating income. If you look at net income, again, fourth year in a row of GameStop improving their net income, 22, 23, 24, and now 2025 on pace for an even wider improvement in net income than any year that they've reported since the Cohen takeover. So as you look at those numbers, right, that 33% equates to a $273 million gross profit compared to a 257 of gross profit in Q3 of last year. So year over year, gross profit actually increasing despite 1,400 fewer stores than last year, right? An incredible, incredible number. Store-related SG&A, which is a segment within their total SG&A, is dramatically lower than it was a year ago, right? From 246 to 186. SG&A as a percentage of sales, right? Down to 27% compared to 33% a year ago. Operating income is at $41 million compared to a loss of $33 million last year. So a massive swing. And that 41.3 is kind of artificially suppressed, artificially lowered by asset impairments related to their unprofitable French business that they have set aside and held for sale. Their interest income at 91.2 million in interest generated from cash, but lowered by a $9.2 million loss on Bitcoin and a one-time non-cash $42 million interest expense. That's not really an interest expense, but it's just the legality of how GameStop has to account for their warrant issuance to the convertible debt holders. Because these convertibles are still right now in debt form rather than equity form, as they probably will be one day. That means that when GameStop issued warrants during Q3, they had to record the value of the warrants, which are not paid by GameStop, right? It's not money out of GameStop's bank account, right? But the value of the warrants gets listed as an expense rather than simply an activity that happened within their equity and diluted float. So regardless, still making far more money on their cash than they were a year ago, right? From 54 million up to 91 million. If you wanted to net out the Bitcoin, then you'd say, okay, or to include the Bitcoin, you could say, well, 54 million up to 82 million year over year. But even if you take out that 42.2, which is, again, a non-cash event, still that leaves you with $77 million of net income, which, again, substantially higher than 17 million from the year before. So operating income swinging from minus 33 to positive 41. Is that bullish or bearish? Again, bullish. Interest income, is that bullish or bearish? Really, like, I mean, you could say bullish. It's really like nothing. Like, the long-term valuation of GameStop is not contingent on how much interest they can generate at T-bill rates. So it's neither really bullish or bearish, but if it's anything, it's bullish, right? They're generating in cash. They generated $28 million more in cash just from interest than they did a year ago, even when you account for their Bitcoin loss. And net income, right? More than what? Quadrupling, right? Yeah. Is that bullish or bearish? Obviously, that's bullish. So those are some of the highlights. A couple things I haven't talked about. Quarter over quarter hardware sales declined substantially. Is that bullish or bearish? It's kind of like, I mean, you could say bearish, but you never like to see that number. Is it long-term concerning what caused this, right? What's going on? Basically, Q2 was the launch of the Switch 2 sales, and the Switch 1 came out 7 years ago. So basically, there's several years of pent-up demand waiting for the Switch 2 to come out. particularly when you think about console cycles, generally year one is, going to do X. Year two will sell more. Year three will sell more. Year four will sell more than those previous years that a new console is released. And then it begins to taper off. Year five is lower than year four. Year six is lower than year five, etc. So you have 3 years after the peak, right? 4 years of increasing Switch sales, and then 3 years of declining Switch sales, waiting for the new Switch. So what happened? A ton of people bought it right away, far more than what Nintendo anticipated. And as a result, that basically pulled forward some Q3 sales and inflated Q2 sales. So after Q1 of a $345 million hardware income revenue line, right? If you were to imagine that, like if you were to steady the curve of Switch 2 sales, and let's take the lumpiness out of it, let's take up the pent up demand and kind of smooth it out, you could kind of imagine, okay, well, what if they went from like between these 2 quarters, GameStop sold 960 million in Switch sales. So you could, well, in hardware sales, you could kind of envision it like, well, what if they did 450 in Q2 and then 550 in Q3, right? Or 440 and then 520 or whatever the numbers end up being. Like that's just as valid of a way to imagine the revenue, but from a quarter over quarter basis, it looks rough only because Q2 looked almost like artificially high, right? The Q2 year over year numbers in hardware are ridiculous, right? Hardware sales per store went up 125% year over year in Q2. In Q3, the year over year numbers are still 47%. Is there a big picture concern about the demand for the Switch 2, right? That would be the true bearish interpretation. And the reality is Nintendo has only raised their guidance since Nintendo reported on their end that their Q3 Switch sales were actually lower than their Q2 Switch sales. And despite that, they said their Q4 is on pace to do far more than even their Q2. So is this a sign of things to come, right? Is the Switch 2 already matured and now it's just declining from here on out? No, it's just pulled forward demand that inflated Q2 that kind of makes Q3 look weak, but big picture long term, the Switch 2 has years left of increasing year over year sales before you need to worry about has the Switch 2 saturated its market. So one of the least sexy parts of the earnings report is the quarter over quarter numbers, but not a concerning thing from a big picture, the health of the Switch 2, demand for the Switch 2. It's not really a sign that GameStop's unable to sell these. It's really just a sign that Q2 sold more than it really should have because so many people have been really, 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 really wanting it. And so they didn't wait. They bought it right away. And we will see a Q4. If Q3 declined in line with the extent that Nintendo said it declined, then Q4 will likely increase in line with the extent that Nintendo said it will increase. These are not my official Q4 numbers, just placeholders for now. I'll dive into estimates in future videos, and we will get there. But Q3, that's one other big takeaway is, man, Switch 2 sold a ton in Q2. And overall is, hardware sales per store, in spite of that decline quarter over quarter, is actually still growing at 47% year over year. So again, is that bullish or bearish? A little bit of a mixed bag, specifically quarter over quarter, but big picture zooming out, obviously 47% growth is incredibly explosive and very bullish. What else? Power packs. So digital power packs did not get reported. So GameStop mentioned this in their 10Q. So the transactions related to power packs were not material in Q3. I will dive into this in future videos of the implications for GameStop as far as the long-term valuation of their business, the growth arc of their business. But what's important, so power packs likely not included in this collectibles number, and yet collectibles year over year are growing at 150% as far as collectible sales per store. Collectibles total sales, right? Even though they have 1,400 fewer stores, collectibles total sales are still growing 32% plus year over year. And that's without any digital power pack. So is there a long-term, is the ceiling lower of what GameStop could ultimately accomplish if digital power packs in the long term is not material? Yeah, that lowers the ceiling of what GameStop could fundamentally accomplish. Is the fact that power packs, digital power packs were not material in Q3, is that a bright red flag as far as its ability to become material in the long term? No, it's not a bright red flag. It's a yellow flag for sure. It's like, wow, thought it would have done more, even though, again, it's just beta, even though they just started, thought that it would have been reported and been material, but now we know that it was not material during Q3. So we will dive into the implications for GameStop in future videos. Again, give a like, subscribe if you want to learn about this. Okay, keep following along because we're covering it here. But if you wanted to take a more pessimistic view of the company, then just pretend that digital power packs will never be material. Just pretend that it will never do anything, right? Well, then what's the growth engine? Like, what's the growth story? I don't know, maybe 150% year over year growth, you know, in their collectibles per store. Maybe 60% growth in their total sales per store, right? So is digital power packs needed to fundamentally support GameStop or to illustrate growth within GameStop's core business? No. Digital power packs is literally not included in these numbers, and yet these numbers on a per store basis illustrate explosive growth. Is the ceiling higher if digital power packs comes into its own? Yes. Again, we'll dive into it soon. But is the floor in any way threatened even if digital power packs never materializes? No, the floor is still rising very quickly, right? And the growth is still showing no signs of slowing down on a per store basis, right? And unless you want to talk about specifically just the quarter over quarter decline with Switch 2, but that is not a signal for long-term declines in the Switch 2. That's just a signal of how much the demand was pent up for Q2 for the Switch 2. You tracking? Okay. If you have any questions on the numbers, would love to hear it in the comments. Any other thoughts on or anything I missed that you felt like, hey, this is high level? Like the point of this video is let me summarize their earnings, right? What are the big picture ticket takeaways? The big pictures are we still don't know anything about digital power packs, right? So as far as the disappointments, that's number one. We have to wait at least one more quarter before we learn hardly anything about their digital power packs business. We also learned that Switch 2 was pent up and really inflated their Q2 numbers, which gave a disappointing feeling to their Q3 numbers. But according to Nintendo, Q4 is set to shatter Q2. And the big picture full year sales and growing sales for the console cycle, certainly you would anticipate 26 would be even higher than 2025, 2027 would be even higher than 2026, and 2028 would be even higher than 2027. And of course, this is not the only console that GameStop sells. And before 2028 gets here, we are also going to have new PlayStation and Xbox consoles, and probably even fewer stores, and probably even more efficient sales per store numbers. Highly, highly efficient business, still closing stores, still cutting costs, decreasing liabilities, decreasing SG&A, increasing cash, increasing operating income, increasing net income, and overall, as a result, is valued on a cheaper on a PE basis now than at any point in this entire Cohen era. GameStop has never been more affordable, has never been priced lower than it is right now. Can you imagine that? GameStop's actual enterprise value, when you value that on a PE basis, it has never been lower than it is right now. GameStop has never been priced lower than it is right now, despite 4 years and running of lower SG&A, lower costs, 4 years and running of cutting stores and becoming more efficient, 4 years and running of increasing net income, 4 years and running of increasing operating income, 4 years and running of increasing their gross margins. And is it 4 years and running of increasing cash? No. But in the past year, dramatically increasing cash, and in the past year, dramatically increasing sales per store. So the top line and the balance sheet just now kicking into gear, but the big picture income statement as far as margins, SG&A, operating income, net income, 4 years and running of dramatic improvements, right? Net income, a 343% improvement year over year. Operating income, a 223% improvement year over year. And again, all of those numbers are worsened by the fact that they still have Europe and Australia on the books, right? All of their efficiency numbers, their sales per store numbers, their profitability numbers, they are hurt by Australia and Europe. And Australia and Europe are not going to be on the books forever, right? So how much more runway does GameStop have for next year to show yet another year, right? A fifth year of even more operating income, even better margins, even more net income, even lower SG&A. And then the year after that, when they don't have to pay to close the stores anymore, because they still have to close them. And when they close them, it costs money to close them. So let's say they close them next year and the rest of this year. Well, they had to pay money to do that. So then how much more does then 2027 demonstrate even lower SG&A and even higher sales per store, even better margins, right? Even more operating income and net income. The fundamental runway for GameStop is 4 years historically supported and many years to come of clear skies. So very exciting from a long-term perspective, very bullish from a long-term perspective. From a short-term perspective, depressed by the fact that switch to quarter over quarter looks lame due to pent-up Q2 sales, and power packs not in these numbers and not ultimately material in its first quarter, which is a disappointment for the hyper excitement of how much long-term value digital power packs could ultimately create. None of that is necessarily threatened by the Q3 lack of information and lack of materiality, but it certainly delays the timeline by which that super exciting long-term value can be created. But again, even without those numbers, right, even without power packs doing anything, and even without cash being deployed into anything, right, GameStop didn't buy any businesses, right? They didn't buy more Bitcoin. They didn't buy any stocks, right? This is just cash and T-bills and the same Bitcoin that they already had going into the quarter, plus 150 or whatever, 130 million of cash that they just made from their business. Nothing has happened with cash deployment. Nothing has happened with digital power packs on their as far as their Q3 earnings goes. And yet their year-over-year numbers are still showing explosive growth. So the most exciting, most hopium levels of how GameStop could eventually become fundamentally worth many, 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 many times what it is right now. You didn't see much progress as it relates to that. But as it relates to, man, the floor of GameStop's valuation and the deep fundamental value that GameStop currently is trading at, well, it's never been more apparent ever than it is right now. One other way to look at it is their cash flow, right? Year over year, their operating cash flow improved by $438 million. So again, this is operating cash flow. So operating income has been growing, right? Again, this is the fourth year in a row of growing operating income, but those income numbers are still hurt by the costs of divesting from all of their different international businesses, right? From Canada, from Germany, from Italy, from France, right? There's so much fluff that GameStop had amassed in its scaling back in 2012 and 2015 and 2016. It's taken years to unwind from all of that. And those costs and depreciation costs, right? They kind of deflate GameStop's true operating income, their true earning power, which is why free cash flow, is a great signal for long-term investors to say, man, a year ago, just 1 year ago, they still were not free cash flow positive from a business. They were in total because of their interest income, right? But from just their operations, they spent $17 million more than what they brought in a year ago. This year, in just 3 months, this is just the 9 months ended November 1st, right? So in only 3 months, they have cash flowed $421 million, and that's before Q4, which everyone knows as a retailer is the most important, most impactful, most profitable, highest sales quarter in the calendar year. Pretty dramatic, the outperformance across the board on year-over-year numbers. Certainly an exciting time where the floor is rising in GameStop's fundamental value, and yet the stock is trading cheaper than ever. So if the market value keeps going down, the fundamental value keeps going up, and we're finally at that threshold, that crossover, right? That data point where all of a sudden the fundamental value is breaking through the market value. Very exciting. Hopefully you learned something in this video. If you did or if you didn't, or if you felt like there's anything huge that I failed to cover as it relates to the high points, let me know in the comments. All right, that's all I got for you today. I will see you in the next one.